Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Risk Concepts and Categories. Understanding risk concepts and categories is fundamental to strategic financial risk management. The identification and measurement of risk are crucial steps in developing effective risk management strategies. Risk, in essence, refers to the possibility of an adverse outcome, which may impact an organization's financial health, operational efficiency, or strategic objectives. It is imperative to comprehend the various types of risks and their potential impacts to manage them effectively. Risk can be broadly categorized into several types, including market risk, credit risk, operational risk, and liquidity risk. Each of these categories encompasses specific elements that need to be understood and measured accurately. Market risk, for instance, is associated with changes in market prices, such as interest rates, currency exchange rates, and commodity prices. This type of risk can have significant implications for an organization's portfolio and financial position. For example, the 2008 financial crisis highlighted the severe consequences of market risk, where fluctuating asset prices led to substantial losses for financial institutions globally. Credit risk pertains to the possibility that a borrower will default on their financial obligations, leading to financial losses for the lender. This type of risk is particularly significant for banks and other financial institutions. Measuring credit risk involves assessing the creditworthiness of borrowers, which can be done using various models and methodologies. For instance, the Basel III framework introduced stricter regulatory requirements for banks to manage credit risk effectively, emphasizing the need for robust risk assessment and capital adequacy. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. This category includes a wide range of potential issues, from technical system failures to fraud and human error. The infamous case of Barings Bank's collapse in 1995 serves as a stark reminder of the impact of operational risk. A single rogue trader, Nick Leeson, exploited deficiencies in the bank's internal controls, leading to losses of $1.3 billion and ultimately the bank's bankruptcy. Liquidity risk arises when an organization is unable to meet its short-term financial obligations due to an inability to convert assets into cash without significant loss. This type of risk can lead to severe financial distress and even insolvency. The 2007-2008 financial crisis underscored the importance of managing liquidity risk, as many institutions found themselves unable to access sufficient liquidity, exacerbating the crisis. Effective risk management requires not only identifying and categorizing risks, but also measuring and quantifying them. Various tools and techniques are employed to measure risk, including value at risk, stress testing, and scenario analysis. VaR, for example, is a widely used measure that estimates the potential loss in value of a portfolio over a specified time period, given normal market conditions and a certain confidence level. It provides a quantitative measure of market risk, helping organizations to understand the potential impact of adverse market movements. Stress testing and scenario analysis are also critical in measuring risk, particularly in assessing the impact of extreme but plausible events. These techniques involve simulating various adverse scenarios, such as economic recessions or market crashes, to evaluate their potential impact on the organization's financial position. For instance, following the 2008 financial crisis, regulatory authorities have mandated regular stress testing for banks to ensure their resilience to adverse economic conditions. Moreover, the integration of advanced statistical and computational methods has enhanced the precision and reliability of risk measurement. Machine learning algorithms and big data analytics are increasingly being utilized to analyze vast amounts of data, identifying patterns and correlations that traditional models might overlook. This technological advancement allows for more accurate risk assessment and better informed decision-making. In addition to these quantitative techniques, qualitative assessments play a crucial role in understanding risk. This involves evaluating the broader context, including regulatory, economic, and geopolitical factors that might influence risk exposure. For example, changes in regulatory policies can significantly impact the risk landscape for financial institutions. The introduction of the General Data Protection Regulation in the European Union has heightened the importance of data privacy and security, posing new operational risks for organizations. Furthermore, a comprehensive risk management framework involves continuous monitoring and review. Risk is dynamic, and its nature and magnitude can change over time due to various internal and external factors. Therefore, organizations must establish robust risk monitoring systems to track risk exposures and ensure timely identification of emerging risks. This ongoing process allows for proactive risk management and timely implementation of mitigation strategies. The effectiveness of risk management also depends on the organizational culture and governance structures in place. A strong risk culture, where risk management is ingrained in the organization's values and practices, is essential for effective risk management. This involves fostering an environment where employees are encouraged to identify and report risks, and where risk considerations are integrated into decision-making processes at all levels. In conclusion, understanding risk concepts and categories is fundamental to strategic financial risk management. It involves identifying various types of risks, measuring them accurately using both quantitative and qualitative methods, and continuously monitoring and managing them. By comprehensively understanding and effectively managing risks, organizations can enhance their resilience, protect their financial health, and achieve their strategic objectives. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.